Today in this video we'll focus on profit taking. Most crypto content, as you know if you've been around and watching other YouTubers, other videos, most of the content focuses on what to buy, when to buy, predictions, narratives. Almost nobody talks about how to sell correctly. And the difference between someone who just got lucky and someone who builds wealth cycle after cycle is in the selling part. Most people in crypto don't lose money because they buy bad projects. They lose money because they never take profits, they panic sell, they ignore taxes, they reinvest emotionally. And hopefully after this video you never do any of these mistakes, and also you know exactly when and how to take profits. You understand stable coins as a strategic tool. You have to understand taxes in your own country. I know a lot of you are based in the USA and Europe. Over here I'm personally based in the UAE and things are a little bit different there with taxes. Hopefully by the end of this video you also know how to legally pay less tax and how to reinvest profits smartly and safely. First of all, unrealized profits are not profits. So if your portfolio shows that you're up by $50,000 but you haven't sold anything, you are not in profit. You're not up by $50,000 because you haven't actually sold, and those are unrealized gains. Crypto markets are fast, emotional, violent at tops and bottoms. And a lot of beginners, when they come to crypto, they think they can sell at the top, but there is no bell at the top, no notifications, no warnings. Market tops feel euphoric. Everyone is so bullish. Everyone says this time is different. We are going to the moon. And this is why people don't sell. And this is personally one of my mistakes when I first came into crypto. But smart money sells into strength. Retail sells after the crash. And if you don't decide how to take profits before you even buy, emotions will decide for you. And emotions are terrible investors, I can tell you. Professional investors and those that have been around for some time, they don't marry coins. They don't believe in narratives forever. They don't hope. They manage risks, probabilities, and survival. And those that have been around never ask, will this project go higher? They ask, what happens if I am wrong? That's why profit taking is planned before you even enter. Before buying, you should already know where will you take partial profits, how much will you sell, where will that money go, how taxes will be handled. But a lot of beginners, when they come into crypto, they buy first, they think later. They feel emotions, they react. But the professionals and those that are experienced investors, they plan first, they execute calmly, and they never ever react emotionally. One of the golden rules that I can share with you from experience is you never sell 100% at one price. Nobody times the top. Nobody. It can't be timed perfectly. Instead, you should scale out. And if you have, let's say, a small portfolio of $1,000, you can plan your exits at 50% gains. Let's say you would sell 20% when this project you've invested in is 50% up. You would sell another 20 at 100% up, which is like 2x. Then you would sell 30% at 200%, and you can let the remaining 30% running. What happens when you do this? You recover your initial capital pretty quickly, you lock profits and you reduce stress, and you also still benefit if price keeps going up. But if the price crashes later, you already won. You already secured your profits. If you have larger portfolio, let's say you've invested $20,000. First, again, the same analogy, you should sell to recover your initial capital, your initial investment. Everything left becomes house money. Fear disappears, decision making improves when you do that. You stop watching charts all day. This is what freedom feels like. And you should follow the same process. At, let's say, when you double your money, you can take your initial investment out. At 50% more increase or at 100% increase, you can take 30%, 40%, whatever strategy suits you. Of course, this depends on your goals, on your experience, on your risk tolerance. Market tops, they don't feel like danger, they feel like confirmations. News is positive, social media is euphoric, everyone has price targets. That's why profit taking must happen before the euphoria, before you start seeing about this project everywhere. You should be already taking profits and sticking to your plan. If your plan is, I'll decide later, I'll see how this goes, you already lost. The market rewards preparation and it punishes randomness, it punishes impulsive decisions. And of course, when you take profits, you don't immediately go to fiat. You move into stablecoins first. And stablecoins are cryptocurrencies pegged to the US dollar. You've got USDT, USDC, and other stablecoins, but those are the two most popular. And stablecoins are powerful because they remove volatility. They lock profits, they create optionality, they calm your psychology. When markets crash, others panic, but you deploy. When markets pump, others chase, but you wait. And professional and experienced people portfolios always have stable coins, even in bull markets. Hope is not a strategy, but liquidity is, and making the most of the market liquidity is what will make you win in crypto. When you're fully invested, every red candle hurts, every tweet influences you. When you hold stable coins, this helps you to think clearly, you sleep better, you act rationally. The psychological edge alone is worth everything if you have stable coins in your portfolio. You might not see the importance of this right now, but if you're for some time into crypto, you would see how quickly you can act when there is a crash, and this helps you buy projects that you want to buy. And when there is a crash, you feel calm because you've already been taking profits and it's in stable coins, and this actually afterwards helps you to reinvest at the right time. And when it comes to taxes, in the United States, for example, crypto is treated as property. Selling crypto triggers capital gains tax. Ignoring taxes does not make them disappear by any means. It just makes the process more painful later. And the goal is not to avoid taxes. The goal is to pay the minimum legally required. So first thing to understand when it comes to crypto, and of course, as I said at the start, every country will have different requirements. But if we focus on the US, crypto in the US is treated like property, not cash. That means every time you sell, you swap, you use crypto, the RSI may want a cut. And what is considered as taxable event in the US? You pay tax when you sell crypto for USD, swap crypto for stable coins, USDC or USDT or another stable coin, swap one crypto for another, you use crypto to buy something, or you receive crypto as income from staking, airdrops, rewards. Just holding crypto, that's the only thing that is not taxable. And there is short-term versus long-term, which is a very important point. Short-term capital gains. This is when you hold crypto for less than 12 months and you sell it or you swap it or you do some kind of activity with it. This is taxed like your regular salary. It can be as high as 37%. And there is long-term capital gains. This is where you hold projects or you hold crypto for more than 12 months, it could be taxed at 0%, 15%, or 20%. So let's say if you bought Ethereum at $2,000, later you sell it at $5,000, so you're in profit of $3,000. If you sell before 12 months, you'll be taxed at 24%, which is $720. If you wait after 12 months, your tax will be 15%, and that means like $450. Same trade, same profit, just waiting saved you $270. Time alone can reduce your taxes. But here is the choice that you need to make. Is it worth waiting on this project, or should I sell that? If it's a meme coin, probably it's not worth waiting. If it's Bitcoin, Ethereum, Solana, probably it is worth the wait. So crypto income, like things like staking rewards, airdrops, mining rewards, these are taxed when you receive them as income. Again, when you sell them, that's the capital gains. And yes, you can have even double taxation if you are not careful. So you can further research about the US if you want to know more, if you're interested in long-term and short-term capital gains and how to deal with those. When it comes to Europe, Europe does not have one single crypto tax rule or law. Every country is different, but most countries follow one of these three models. One of the models is tax-free after a certain holding period. An example here is Germany. I know that from a friend of mine who is based in Germany. If you hold crypto over 1 year and you sell it, you get 0% tax. And long-term holders win here. The second model is fiat capital gains tax. So example here are France and Italy. You've got fixed tax rate, usually 20 to 30%, and holding time doesn't matter here. And the third model is income-based or progressive tax. You've got here examples like UK, some of the Nordic countries. Crypto gains are added to your salary. Higher income, higher tax, and it can get expensive pretty fast with this model. And again, when it comes to stablecoins in Europe, swapping crypto to stablecoins, this is taxable. A lot of beginners from my experience and on my Discord miss this point. It's important to know this. And this is very important and dangerous because let's imagine you make $100,000 profit. You reinvested everything. The market crashed and your portfolio dropped to $30,000 and your tax bill arrives. The government wants tax on the $100,000 that you made profit on initially, even though you only have $30,000 left right now. So you owe tax on money you don't have anymore, which is very dangerous, and you should be very careful when it comes to how you reinvest and how to manage your money. So I would say taxes don't care if you reinvested or if you took your profits, and taxes don't care if the market crashed or it went up. If you don't plan for taxes, taxes can really destroy you and eat all your profits and even make you lose. So if you're just starting with crypto right now, I would say track every single trade that you make. Set aside money for taxes. Don't reinvest the whole of your profits, 100% of what you've made, and hold longer. Holding longer can save you thousands sometimes. And of course, stable coins doesn't mean safe from taxes. It could be taxed as well. And some of the strategies that I just mentioned to make you pay less taxes is to hold longer where possible, scale profits across years, use losses to offset gains, and don't overtrade. And always separate tax money immediately, because tax money is not your money. And I would say set aside 20-30% of profits in stable coins. Make sure you have some stable coins in your portfolio at all times, and put that in a separate wallet, and don't touch your tax money, just leave it there. And as I said, you must track your buy prices, sell prices, dates, fees, wallets, and you can use tools like Coinly, Coin Tracking, CoinLedger. Those are useful software that you can use and calculate your taxes. If you do this now, if this becomes your habit, especially if you're in a country where tax is important, as I said, I'm personally based in a country where I don't pay taxes, but if you pay taxes, you should make this your first point and habit, because in the future you can only thank yourself for doing this. And if you were to split that into percentage, you would reinvest. If you wanted to reinvest, maybe 60% is a healthy reinvestment, and you should hold 20-30% in stable coins, and 5-10% should be reserved for taxes. It's a boring rule, but it will help you in the future. And in my tips, I mentioned something interesting: using your losses to offset your gains. What I mean by that, there is a term called tax harvesting. This means using your losses to reduce your taxes. In simple terms, you intentionally sell losing investments, so you pay less tax on your winning investments. So basically, you're turning your losses into a tax advantage. And if I want to further simplify that, let's say you've got $10,000 profit on Bitcoin. $4,000 you lost on altcoin. You invested in, let's say, any altcoin. You invest in that and you lost $4,000. So if you do nothing, you pay tax on $10,000, your full investments. But if you use tax harvesting, this means that you only pay tax on your $6,000 profit on Bitcoin. The same trade, the same year, just lower tax bill, which is, I think, you would be happy to do that. How this actually works: losses only count after you sell, as we said. If your coin is down but you never sell it, that loss does not exist for tax purposes. So how tax harvesting works really: you sell a crypto that is down in price. That loss becomes a realized loss after you sell, and that loss offset your realized gains, and you owe tax on less profit. So losses only count after you sell, though unrealized losses don't count. In the United States, crypto losses can offset crypto gains. That's a law that is available there. So if your losses are bigger than your gains, you can reduce up to $3,000 of regular income, and you can carry the rest forward to future years. And here is something important. As of now, crypto does not have a wash sale rule like stocks. That means you can sell at a loss and potentially buy back right away and still claim the loss. Always, check the current rules, because laws can change pretty quickly, especially as crypto becomes more regulated. When it comes to Europe, in Europe, tax harvesting depends on the country. Many countries allow losses to offset gains. Some allow less carry forwards. Some have restrictions. This is why knowing your local tax rules is critical, because there is no one rule for every country, for every location. And tax harvesting is not panic selling. You have to differentiate between the two. Panic selling is emotional, and tax harvesting is actually a strategic move. You're not selling because you're scared. You are selling because it reduces your tax bill, and this is your strategy, and you have more confidence in that move compared to holding this project and keep losing. So I would say don't marry your bags. Know when you would exit before you even decide to enter and before you even decide to buy. Once you've bought, try scaling out. have stable coins, think about taxes, plan ahead, plan your reinvestment. How much are you going to reinvest? How many are you going to position or hold in stable coins? And if you do those simple things that are part of your strategy, I can tell you that you outperform most people in crypto. Not once, but for life. So that's for me today. Thank you so much for watching. I'll see you in the next video.